Silver didn't just drop on Friday. It got pushed off a cliff. A 39% plunge in one session, so fast most people couldn't even react. And the real scandal isn't that the price fell. The scandal is what didn't fall with it. Because while the paper chart was imploding, the companies that actually pull silver out of the ground barely moved like they believed the crash was fake. That divergence is the smoking gun. Welcome back. I break down what markets are doing behind the headlines. Subscribe now because the next time this machine pulls a lever, you'll want to see it before the crowd gets trapped again. Now let's get straight to what happened. Silver printed a historic one-day collapse. Headlines screamed, "Bubble popped." Analysts blamed speculators. Social media filled with wreckage stories. But when you compare the metal to the miners, the story changes. Pull up the miner ETF. Real mines, real payroll, real ore grades. Miners usually amplify silver. It's one of the most reliable relationships in commodities. Silver up 10%, miners often up 20%. Silver down 10%, miners often down 20%. It's leverage, operating earnings, and sentiment stacked together. So when silver falls 39%, miners should not politely slide 22%. In a genuine collapse, miners get obliterated, 60%, 70%, sometimes worse. But they didn't. They took a hit, yes, but they did not validate the end of the world narrative. That tells you one thing. The people closest to the underlying business did not price Friday as a permanent repricing of silver's value. They priced it as a paper event. And paper events have a purpose. They transfer the asset from weak hands to strong hands. If you've been around markets long enough, you know the pattern. A crowded trade builds. Leverage piles in. Everyone lines up on the same side. Then a trigger appears. Stops fire. Margin calls start. Forced selling cascades. Price free falls into thin liquidity. And right there, inside the panic, someone is buying what you are being forced to dump. That's how the machine works. So I stopped listening to commentary and started looking for footprints. Footprints don't live in opinions. Footprints live in mechanics, order books, margin rules, and who exits at the bottom. Let's start with the oldest trick in the book that most people still don't understand. Spoofing. Keep it simple. A large player flashes a massive order they don't intend to fill. It's not a real sell, it's a threat wall. Other traders see the size and think, someone knows something. They sell. Price drops. The fake order is canceled. The spoofer buys the dip they created. It's illegal. Regulators have prosecuted it. And precious metals have a documented history of manipulation cases involving exactly these kinds of tactics. Now here's the uncomfortable question. Do you really believe that a market with a long history of enforcement actions suddenly became perfectly fair and perfectly clean, right when silver was in a vertical mania and leverage was maxed out? Or is it more likely the tactics evolved, the execution got faster, and the public still gets handed the narrative afterward? Friday looked like the second option. Because Friday wasn't slow. It wasn't investors changing their mind. It was a synchronized oxygen cutoff. And the real lever that turns a normal down day into a massacre is not sentiment. It's margin. If you want to understand how Friday happens, you have to understand margin in one sentence. Margin is the exchange's remote control for forced selling. In futures, you post collateral. When margin requirements rise, you must post more cash immediately. If you can't, your position gets liquidated. Not because you want to sell, because you're forced to. So margin hikes don't just manage risk. They move price. They decide who gets to stay in the trade. Now think about the timing. If the goal was to prevent a blow-off top, the exchange can raise margin before a crash. Cool the market. Reduce leverage ahead of chaos. That's the clean story. But when margin hikes stack right after a violent move, and then stack again, the effect is different. It doesn't prevent damage. It finishes the survivors. It makes sure dip buying with leverage becomes impossible. It forces more liquidation into a fragile book. And that timing matters because exchanges don't fear your emotions. They fear default. A market can survive red candles. It cannot survive a major player failing to pay. So when you see emergency-style margin behavior clustered around a shock event, you should ask the real question. Who needed protection? Who was underwater? Who needed the crowd flushed out so the system could breathe again? Because that is when the rulebook becomes a weapon. Now zoom out and look at history. Not to be dramatic, but because the pattern is too consistent to ignore. When silver gets loud, when it threatens to break out of its cage, Two tools show up over and over: leverage throttling and narrative control. In past major silver runs, the market has seen sudden restrictions and sharp margin increases that coincided with reversals. Not once, multiple times. Different decades, same mechanism. Choke the long side, force liquidation, reset the book. So when you watch a 39% plunge with miners refusing to confirm it, and you see leverage controls tightening, you're not watching a normal price discovery event. You're watching a reset. Now here's where the story gets even more important for your next decision. Because silver is not just a chart. Silver is two markets: paper price and physical availability. Paper can move in milliseconds without a single ounce changing hands. Physical moves in refineries, delivery schedules, vault inventories, and supply chain contracts. Paper can be slammed by selling promises. Physical cannot be created with a keystroke. So if Friday was a true collapse in value, physical should have been easy, cheap, plentiful. Dealers should have been begging for buyers. Premiums should have dropped. But what did you actually see? You saw physical ignore the crash. You saw premiums stay elevated. You saw out-of-stock banners spread. You saw buyers show up exactly when the screen screamed panic. That behavior is the opposite of a demand collapse. That behavior is what you see when price falls because forced sellers must sell now, not because the asset suddenly became worth less. And that is why the miner divergence matters. Miners are imperfect, but they're real. They are closer to the physical ecosystem than paper traders are. They deal with contracts, concentrates, refineries, and long-term planning. So when miners don't crater alongside the paper smash, it's like a doctor telling you the lab results don't match the symptoms. Something else is driving the chart. Now let's talk about the who benefited problem, because this is where people get emotional and lose their discipline. Every crash creates victims and winners. Victims are easy to identify: leveraged longs, late buyers, anyone with tight stops, anyone trading on borrowed time. Winners are harder because winners don't speak in real time. But winners leave footprints in timing. When large participants close positions right into the lowest prints of the day, that's not luck. That's execution. That's preparation. That's someone waiting for the forced liquidation to hand them maximum advantage. And when multiple large institutions appear to behave that way around the same event, you should stop calling the whole thing retail panic. Retail doesn't coordinate synchronized exits. Retail doesn't control oxygen. Retail doesn't write the rules. Retail is what gets harvested. Now you might say, but the price still fell, so it's real. No. Price can be real and still be pushed. A forced move can print on your screen and still be temporary. That's the most dangerous thing about these events. They feel like reality, so you surrender. You sell at the worst moment because your nervous system is convinced it's survival. That is the entire psychological design. They don't just want your money, they want your confidence. They want you to associate silver with pain. Because if the public gets confident in hard assets, the paper system loses control. So the goal is not only to drop price, the goal is to teach you a lesson. Don't touch this. You'll get hurt. And then, when the reversal begins, you're too traumatized to buy. That's how a reset turns into a transfer. Now let's be precise about what changes and what doesn't. Friday's crash did not create new silver mines. It did not expand ore grades. It did not build new refineries. It did not reduce industrial demand. It did not remove silver from solar, electronics, and electrification. Fundamentals don't change in 6 hours. Leverage does. Positioning does. Ownership does. Friday changed who owns the exposure. And if the exposure moved from weak hands to strong hands, the next phase is not about fear. It's about scarcity. Because strong hands don't panic sell into the next dip. Strong hands use dips to accumulate. That's why these events often lead to violent rebounds. After the flush, the market is clean. Stops are gone. Late longs are gone. The book is thinner. And thin books create exaggerated moves, down and up. Now add one more ingredient: distrust. Every time a paper smash happens, more people decide they want the real thing. They buy physical. They demand delivery. They remove ounces from the paper ecosystem. And that has consequences. Paper markets only function smoothly when most participants never ask for metal. They trade promises and close them. The moment too many people want delivery, the system gets stressed. That stress shows up first as premiums and shortages. Then it shows up as rule changes. Then it shows up as bigger volatility. So, ironically, The harder the paper game smashes the screen price, the more it teaches people to abandon the screen. And abandonment is what eventually breaks the illusion. Now, I'm not telling you to gamble. I'm telling you to stop being manipulated by a number that can be weaponized. If you want to track what's real after an event like Friday, you watch 3 signals. Signal 1, miners versus metal. If miners stabilize or recover while spot still looks weak, it tells you the market expects the paper smash to fade. Signal 2, premiums and availability. If paper drops but physical stays tight, that drop is not a clean repricing of value. It's a leverage purge. Signal 3, margin behavior. When margins keep tightening into a wounded market, it suggests stress in the system, not calm. Now I want to pull you into the most important decision point. Because after a flush, there are 2 mindsets. One mindset says, I got burned, I'm out forever. The other mindset says, that burn was a lesson. Don't use leverage, don't chase, use the panic to position. The market rewards one of those mindsets. It punishes the other. And the market doesn't care how you feel about it. And don't underestimate what miners represent in the ecosystem. Miners are not a perfect proxy, but they are the market's lie detector because their cash flows are tied to the metal over time, not to one intraday candle. If silver truly repriced lower permanently, miners would have to revalue reserves, renegotiate financing, and reassess expansion plans. That fear hits them immediately, and it hits them harder than spot. So when miners don't implode alongside spot, it suggests the institutions holding them believe the crash is a paper distortion that will mean revert, not a new reality for the next 5 years. That's why I keep calling it a tell. It's the closest thing you get to a professional vote in real time. Now let me show you how these air pockets are built, because once you see the mechanics, you stop taking the move personally. In a crowded market, the book is stacked with stop-loss orders under obvious levels, round numbers, previous lows, overnight support, places where everyone puts the same safe stop. Algorithms know those levels. So the first wave of selling doesn't need to be huge. It just needs to break the first support line. That triggers stops. Stops become market sells. Liquidity pulls back when speed increases. Price drops harder. That triggers the next stop cluster. Then margin calls hit. Then forced selling accelerates. The book turns into a waterfall. And in real time it feels like the world discovered bad news. But it's not news. It's mechanics. Crashes are always faster than rallies because forced selling is automatic. Now here's the part you need to hear clearly. In these events, the bottom is where the smartest people execute, because the bottom is where the crowd is forced to hand over assets. That's why the minor divergence is so disturbing. It suggests that while the paper market was in free fall, a different group was saying, hold the real exposure. Now you might ask, what would temporary even mean after a 39% drop? Temporary doesn't mean it snaps back to the high tomorrow. It means the move was bigger than the fundamental change. It means the paper market overshot because leverage was forced out. It means that once the forced sellers are done, price can re-anchor toward the real clearing level. And what is the real clearing level? It's the level where physical metal actually changes hands without the market seizing up. That's why premiums matter. Premiums are the truth tax. If premiums stay stubborn while spot looks cheap, you're not looking at a bargain. You're looking at a warning. The screen is lying about availability. Now let's get practical for a moment. Here are the 3 mistakes that destroy people in events like Friday. Mistake 1. Trading size you can't hold. If you can't sit through a 10% intraday swing without your stomach turning, you're too big. Mistake 2. Using leverage in a market that can change the rules. Leverage is permission for the system to liquidate you when margins rise. Mistake 3. Emotional anchoring to the last high. The market doesn't care that you saw $121. The market only cares what clears today. Now here's the better framework. Position like a professional. Small enough to survive, liquid enough to add, patient enough to wait. That's how you stop becoming the supply at the bottom. Now here are the 2 questions I want you to answer in the comments, because your answers tell me where the public is emotionally, and emotion is fuel. Question 1. After seeing miners refuse to validate a historic silver crash, do you trust the paper price as a real signal of value? Yes or no? Question 2. In your view, was Friday mainly liquidation or a true repricing? One word, then a short reason. Drop your answer. I read them. Now, a short CTA that actually matters. If you want the next breakdown before the next lever gets pulled, subscribe. No fluff. The next move won't wait for you. And one more cliffhanger before we close. If Friday required a crash this violent to reset positioning, then the pressure underneath the surface was bigger than the public was told. Pressure doesn't disappear. It relocates into inventories, premiums, and the next rule change. So the question isn't, did silver crash? The question is, what does the system do next to keep control if the physical market keeps tightening? Because that's where the real story begins. Friday was not a conclusion. Friday was a stress test. A stress test reveals where the system is fragile. The paper market's fragility is confidence. It needs you to believe the screen. The physical market's strength is reality. It doesn't care what the screen says when supply is tight. So watch what happens next. If physical tightness persists while paper tries to hold price down, the gap widens. And gaps don't close gently, they close violently. Either paper snaps upward toward the physical reality, or confidence in the paper mechanism snaps downward. And when confidence snaps, you don't get a polite move. You get a repricing event that makes Friday look like the warm-up. So don't obsess over the crash. Obsess over what refused to crash. The miners, the premiums, the availability. Those are your truth sensors. Now watch what happens.